Hi everyone, welcome to the Great Unicorn Hunt Knowledge Series. Today's topic of discussion is how not to lose money in early stage investing. Today our guest is Aditi Balbir, an angel investor turned entrepreneur with two investments and two ventures of her own. She is also a mentor and advisor to female-founded startups in early stage ventures. Hi Aditi, welcome to the Knowledge Series.
Thank you. Thank you so much, Ritika.
Okay, so let's start with your journey as an early stage investor. How has it been so far?
Yeah, so in fact, I wouldn't say that I'm nowhere near an expert or anything like that. In fact, I always prefer being, from the or seeing things from the lens of an entrepreneur, right? So I would always say I'm an entrepreneur and not an investor as such, right? But yeah, the journey has been interesting. I mean, lots of learnings. You get to keep track of what's current, and especially in my sector is a big growing sector, so it's very exciting to meet new technologies and meet new companies that are working on this on the field of sustainability. So it's a path with very, very high learnings, I would say, right? And also great insight into which ventures get funded, which don't, and really how do you go about garnering that money, right?
Got it. Okay, moving forward, I'm sure our viewers would like to know as to what is your process getting familiar with the early stage investing? Like, how did you really prepare as an early stage investor?
No, I don't think we prepare. See, we are entrepreneurs. So once you have taken your own company from inception, then you've done your own fundraising, Series A, Series B, then you go on to, do the exit. So you kind of know what happens at each stage in a particular company, right? So there's no prep as such that you have to do. Yes, there is, when you look at a company, there are certain prescribed formats. So I made my own format of what sort of information I want to look at level one. What are the things that I'm going to look at level two? It takes some time to build some sort of a thesis or a hypothesis around what investments will do well. So to that extent, we're always very happy to see YC invested companies, or we like to see the journey of guys who have been extremely successful, right? So that's interesting. And even in fact, I used to work with a couple of funds as well. So the way that they invest and what sort of criteria they use to figure out the investment and what sort of fits into their hypothesis, to build your own, it takes a lot of time, right? So initial stages of investment are more about how you gel with the team. I also have a hypothesis of my own that I should be able to contribute in some way. Hospitality is my forte. So if I can open avenues for the company in hospitality, that's a typical company that fits my bill, so to speak. So, but unfortunately, life is the best prep, yeah, for becoming an early stage investor. And you'll find people who are already very seasoned doing their businesses themselves, who become angel investors or early stage investors. So that's really it. Very high risk appetite, because obviously, early stage, so risk bahut zyada hota hai. So you also have to figure out what stage you want to come in, pre-revenue, traction, or revenue positive, or when the company is profitable. All those things really determine the early stage investing decisions.
Got it. So, since you have experience in, I guess, both of the part, like as an investor and as an entrepreneur, as a founder, so what do
Right.
you think are some of the pitfalls or obvious red flags that a lot of early stage investors tend to ignore?
So I think the early stage investments, like I said, are very risky. So you also always have to look at promoters, their backgrounds, where they come from, how important the venture is, what is the opportunity cost like, because it is always very tough. So it's the easiest, if you are three professionals and you start the company, it's very easy to leave also, right? Because you're like,
Right.
oh, nahi chala, let's go get jobs in the market.
Mhm.
So it's very important to look at, their backgrounds. People who come from a certain, say, pedigree, the guys who come from the Ivy League colleges or the schools, or Ivy equivalent like IITs, IIMs, that sort of a thing, always are preferred. Yeah, I mean, you must know this. I think all of us know
Yeah.
there's inherent level of bias in the startup investing stage. So yeah, those are sort of the things you look for. Pitfalls तो सभी कुछ होता है यार, initially तो there's no proven model as such. So I think this time also, if you look at it, and I'm raising money for my own new startup, so I do know that it is investors are looking for a lot of things that can validate the company's hypothesis. So they look for pretty much everything. Yeah, they're looking for traction, they're looking for which customers, they're looking for what's your order pipeline, how quickly will you be profitable. They're even looking for things like how many rounds will you raise. So, in a company which raises multiple rounds, they're it's easier to invest in at the early
Mhm.
stage, because then you know that you'll get an exit sometime or the other. You don't have to wait for the company to do IPO or get it sold by a strategic, etc. Right? So it's great. However, in a company that doesn't need money, after some time, and that doesn't do too many, then you're stuck, because then you're waiting for the exit event to happen, which may or may not happen, right? So I think a lot of these criteria, I mean, I wouldn't call them pitfalls, because it's very rare that you get something right. So as an angel investor, I will always say, play the portfolio theory like the VCs play. Even angels play the same theory. Yeah, they have 30, 40 investments, and then they know that two or three of them will be blockbusters, two or three of them will have decent exits, remaining will fail. That sort of a thing. So even to become an angel, an early stage investor, you need to be able to know that you can write off that money. We used to have some angels who used to come after us, but that's not the inherent nature of equity. Inherent nature of equity is risk. So you can't suddenly come back and act like a creditor कि हमने तो पैसे दिए थे, but you're not a creditor, no, you're an equity
Right.
participant. So you have to really have that mindset that, okay, if it doesn't work out, you write it off. So I think that's something which is important.
That was quite insightful, actually. Okay. So the last question is, what have been some of the good habits or best practices that you have observed in some of the more successful early stage investors?
Yeah, that's a great question, honestly. So the first criteria is that everybody works there full time. So at this stage, you really want to see how much grit the entrepreneurs have. You know that they're not earning anything. Forget about earning market salary. You're not earning anything at this stage,
Yeah.
right? आपका अपना पैसा ही डाल रहे हो. So the
Mhm.
first thing that you really see is, how much grit do they have, because that is like the best criteria to see how far they go, right? I also look at how much money they themselves put in. They could be kids from college, so it
Mhm.
is also possible that they haven't put in any money, but they got money from their friends and family. So that's equivalent. आपने खुद के
Yeah.
पैसे नहीं डाले, but your friends have put to you or back to you. That's good enough. So
Mhm.
some amount of bootstrapping, some amount of their own money, and how much they are able to reach and where do they reach with that, is something which is very important. I feel those are great things for disciplined people. Because if you say, अच्छा मैं फंड रेज करूंगा और फिर जब फंड रेज होगा तब मैं देखूंगा यार मुझे फुल टाइम करना है कि नहीं, that's a big red flag for me. So I would talk to a team where everybody's at it full time, they know the risk, they have put in some money of their own also, so even if the fundraise is delayed, the company won't stop. Okay. And the third most important thing, जो कि early stage companies को समझ ही नहीं आता, okay, which is investor relations. See, you're taking very small check sizes. You're taking 25 lakhs, 30 lakhs, right? So at that time, if you're an entrepreneur, like, look, I can't give my time to these guys, yeah. But the good founders, the really good founders, send very insightful updates, and you don't need to make one mail for each individual. Yeah, one mail has to go out every month from the founders, which shows that yes, we are always available to our investors, we are always available to ask to answer questions, and we are we are very disciplined about investor relations, because that is actually what will ultimately get you the series A, the series B, the series C. So that is something which is a very big thing which at least I look for.
That was quite awesome, actually. I had fun.
I'm giving you all unconventional answers because, like I said, I'm the entrepreneur. So
Yeah.
you don't need investor lens here.
Hmm. So, thank you, Aditi, for taking time out for this interview. I wish you the very best of luck for your startup.
Thank you. Thank you so much.